behalf of CMS Trader and investing.com, and welcome to our class on the basics of fundamental analysis. Now, tonight's class is sponsored by CMS Trader. That's www.cmstrader.com, one of the world's leading Forex and CFD providers. And CMS Trader is a regulated provider, so I'm therefore required to give you a risk warning. So let me read that and get it out of the way. Trading Forex CFDs and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. Now, tonight during class, if you want, you can go visit www.cmstrader.com and just click on the buy or the sell button, and you can open a demo account almost immediately. All it requires is an email address and a password. There's no deposit required, no credit cards required, and then you can follow along and use their platform for your demo trading experience. Now, CMS Trader offers a very broad range of assets, including Forex CFDs, stocks, commodities, and indices. They also offer their Watch, Copy, and Profit, which is their social trading, right on their platform where you can copy most of the successful traders with one click. Follow, see what their best traders are doing, and if you want to duplicate their position, just click on it. And lastly, you can learn how to become an independent trader with CMS Trader. You can use their vast library of video tutorials for beginners and professionals. They have a huge arrangement of ebooks, and you can take, or you'll be invited to one-on-one sessions with a financial expert. Now, tonight's class is being recorded, and if you want to access a copy of the recorded version, in about 24 hours, you'll be able to find it on www.investing.com, where you signed up for the webinar, and locate the education tab, and then look for webinars on demand. And like I said, in about 24 hours, you'll be able to see it there. So let's get started talking about the basics of fundamental analysis. Now, fundamental analysis studies the core underlying elements that influence the economy of a particular entity, like a stock or a currency. It attempts to predict price action and trends by analyzing economic indicators. Now, fundamental analysis can be explained as a method of estimating a security which involves attempting to evaluate its basic value by assessing allied financials, economic, and other quantitative and qualitative factors. Fundamental analysis aims at studying everything which affects the value of a security, including economic factors such as the overall economy or industry conditions, and company-specific factors including financial conditions and management, and things like earnings reports and press releases. Now, this analysis method is taken as the opposite of technical analysis. As explained by Investopedia, fundamental analysis aims at using real data to evaluate the value of a security. Even though most analysts use fundamental analysis to evaluate stocks, this technique can be used for almost any type of security. So anything that's available in a CFD market can be used through through fundamental analysis, as well as assets that are such as cryptocurrencies. Now, the main goal of carrying out fundamental analysis is to generate a value that an investor can weigh against the current price of a security, with the goal of outlining the type of position to take that will for that security. Underpriced would mean to buy, overpriced would mean to short or sell. In terms of stock, Fundamental analysis emphasizes on the financial statements of a company being assessed. Now, fundamental analysis can be illustrated as an example mentioned ahead. Let us assume that an investor can execute fundamental analysis on the value of a bond by looking at the economic factors, including interest rates and overall the state of the economy, as well as information about the bond issuer, like potential changes in credit rating. For evaluating stocks, this method involves the use of revenues, future growth, earnings, return on equity, profit margins, and other data for determining the underlying value and possibility of future growth. So first we have to separate the markets. So we understand that fundamental analysis involves everything from press releases to economic events to central bank action to earnings reports to dividend reports to competitor statements. But how we look at this and where we get the data from depends on the market. So fundamental analysis is a stock valuation method that uses financial and economic analysis to predict the movement of stock prices. So let's first look at the stock market and what we would consider fundamental analysis when you're looking at a stock. So the goal of fundamental analysis is to make financial forecasts, and the fundamental analysis is done on the historical and present data. Let's discuss some highly important objectives of fundamental analysis. It's done to calculate credit risks. It also makes internal business decisions. It is also used to make projections on its business performance. It is also used to conduct a company's stock valuation and predict price evaluation. One of the primary assumptions of fundamental analysis is that the price on the stock market does not fully reflect the stock's real value. And if we determine that the stock is undervalued, we would buy it. If we determined the stock was overvalued, we would sell it. Now, there are many ways to do that. So concepts of intrinsic value take place in fundamental analysis. It's important to address the subject of intrinsic value. In the long run, the stock market will reflect the fundamentals. There is no point in buying a stock based on its intrinsic value if the price never reflected that value. Nobody knows how long the long run really is. An investor can estimate the intrinsic value of a firm from where they can buy at a discount. Basic things is that you don't know whether your estimate of intrinsic value is correct, or even if you don't know how long it will take for the intrinsic value to be reflected in the market price. So earnings is one of the major factors affecting fundamental analysis of stocks. Although earnings are important, they can't really tell you anything about by themselves. Okay, and unfortunately, when we come to fundamental analysis, and we're all looking for these numbers to come out when we go through earnings season, which just ended, and Walmart reports a jump in sales. Too many traders say, that jump in sales is going to make that price rally. So I'm going to buy Walmart stock today. But that's not how fundamental analysis really works. It's really not how the market works. Because like last quarter, Walmart sales were down, but Walmart stock rallied. Why? Because their online growth showed significant improvement. And this is where the future aim is for retailers in the US. So the growth in online sales and their online position made the markets really happy, even though overall sales were down and the stock went up. So they don't identify how the market values the stock on their own. You also need some fundamental analysis tools to begin building a picture of how the stock is valued. Now, the factors that affect fundamental analysis of stock, these ratios aren't difficult to calculate. In fact, you can find them already completed for you on websites like CNN Money or MSN Money Central. You know, the fact is, Too many of us want to go digging deep into all of these earnings reports. Well, it's fine if you're a hedge fund manager who doesn't need a trade right now and might be looking to spend a couple $1 million for a long-term investment. But we're mostly CFD traders who are looking for short-term trades. So why go through all of this effort to do all of these odd calculations when just going to CNN Money, MarketWatch.com, MSNBC, and they're all going to print it all out. Just get Zacks. But if you want to wade in yourself, keep in mind that some of the most popular tools of fundamental analysis focus on earnings, growth, and the value in the market. And there are some of the factors you want to identify and include. You want to look at income statements, balance sheets, cash flow statements. Okay. The income statement measures a company's performance over a specific time frame. Technically, you could have a balance sheet for a month or even a day, but you only want to see public companies' reports quarterly or annually. The balance sheet represents a record of a company's assets, liabilities, and equity. Well, that's a lot for one of us to go through. Then we need a statement of cash flow, which represents a record of the business's cash inflows and outflows. Now, how would you and I analyze Apple's cash when they're sitting with more cash than a whole, in a lot of places, entire countries? The cash flow statement is important because it's difficult for a business to manipulate its cash position. Now, you need to be able to scan an industry and economy so to see future movements of security prices. The fundamental analyst attempts to predict the future stock price based on certain parameters. So how does he determine, or how do you determine fair market value, or what the market value should be? It helps in determining the company's fair value, and also helps you decide whether it's undervalued or overvalued. Fundamental analysis does this for you. The fundamental analyst would love to purchase a stock if the current market price is below its intrinsic value, and would sell the stock when the market goes far above the intrinsic value. Hence, fundamental analysis is important in stock picking. But also we need to look at management evaluation. Who's running a company? Changes in the overall upper management of a company, statements from them, all play a very important factor in determining if a company is going to be successful, coming out of success, or going into failure. So fundamental analysis helps in evaluating management and also to make internal business decisions. Simply analyzing companies' overall performance will not fulfill the goal. Just doesn't. Rather, conducting peer comparison analysis is equally important. And this is what I was saying to you about Walmart before. Okay. All the retail sector was looking at low retail sales. But we saw a growth in Amazon online sales. We saw a growth in several other online selling companies, but Walmart's growth in online sales outpaced them. So it was the comparison between Walmart and its competitors and how well they were doing to how well Walmart was doing. So you should always question yourself before investing in a company that whether the company is in a strong position to beat its competitors in the future. So analyzing company's financial strength. The real test will be to determine a company's financial strength and its ability to repay debts, no matter how good or bad the management or other factors are. But at the end of the financial performance matters due to the high or the huge amount of complications involved in fundamental analysis. People have a tendency to avoid the stock research. One mistake which is very prevalent in the market is that initially after buying the stock without conducting any research, people start researching once the price corrects. Now, it's important to, in a stock market, to have some understanding. Blindly trading in the stock market is worse than blindly trading in gold or the Forex market. Because the stock market, as we all know, is one of the slowest moving markets, and it does show steady growth, and it's a good investment. But a stock, now we're not talking about Walmart, we're not talking about Amazon, we're not talking about the big majors. Okay, they may bump up and down because some press release, but they don't move that much in a day. If you're looking to invest, you're looking to buy something smaller or lower value that's going to have a little bit more movement. Okay, or that you can obtain a bigger position in the marketplace. So you need to do more in-depth research than you do for Apple or Amazon, which is splashed all over the newspapers every day telling exactly what's going on. But they also have a way of exciting the markets or disappointing the markets during earnings season. But otherwise, you need to watch their press releases, what analysts are saying, and figure out what is going in the market. Now, you also have to determine where you want to be in the market to figure out what's relevant to you. If you're looking to buy stocks for your retirement account or for your long-term investment strategy or to hold for a year or two, it's much different than if you're looking to trade it in a CFD in a simple day trade, or if you're a swing trader to hold for 30 days. So you have to figure out first where you fit and what's relevant. So do you fit into long-term investors? These are people willing to hold on positions for a long term unless there's any serious problem associated with the company. They are very patient investors who don't care about the short-term volatility in the stock price. A long-term investor doesn't care if Walmart goes from, and I have no idea what's trading at, but 139 to 133.43 and then falls down to 137 and goes back to 142 because they're looking at it to be at 160 in 3 years from now. That's all they're caring about. This is a long-term investor. Then you have financial advisors. They're very concerned with other parts of the data. These people render financial services and also give stock advice to their clients in terms of what and when to buy and sell securities. So they're looking at more specific type data because they have to give recommendations, and they're recommending not risk, they're recommending to different things, different perspectives to different clients based on their tax needs, based on their financial situation. So they need the best of the best and the deepest information. Then you have value investors. They look for stocks where they are mispricing in the market. Price and value doesn't always match. They try to identify companies which are extremely beaten down, or the stocks which the market is avoiding at the current juncture. One of those best examples right now is Teva Drug. It's been beaten up because the board of directors was making a bunch of messes. They made that acquisition for $1 billion in South America that fell apart, and they've been getting killed with a lot of bad decisions over years. So when it fell to an all-time low, it was a perfect time for value investors because Teva wasn't going away. But you have to be able to wait it out till it climbs back. But this is things you've got to look for. Value investing is one of the best ways for short-term swing investors or somebody who looks to hold something for a year. Okay. Then there's fund managers. These guys work with big fund houses, insurance companies and pension funds, and they manage huge pools of money where they can actually influence the market. Since they have big roles to play and large amounts of capital is at stake, they have a team of qualified professionals to conduct an in-depth stock research. Sometimes you can find comments by fund managers or interviews with fund managers. But you have to understand when you're looking at this data, these press reports and the things that come out in these comments, these evaluations, who is making them and what perspective they are coming from. Now, there's an important tool available. I'm not promoting it, but I fell in love with it, and it's from a company called TipRanks. You go to www.tipranks.com, and they monitor everything going on in the stock market and give you what each commentator, each blogger is saying. They evaluate it. They do all kinds of surveys. But it takes a lot of your time out of all of this evaluation. Now, what about other markets? Fundamental analysis typically refers to a method of analyzing and evaluating equities, though it may also apply to other types of securities. Income statements, balance sheets, cash flow, and other publicly available documents are used to analyze the financial health of a company. Economic data, such as unemployment numbers and interest rates, may also be considered. The goal is to find companies that are trading at a discount to their true value and thus may increase their share when the market recognizes their quality. Now, consider this. The U.S. economy is doing well. The housing reports come out and it shows existing home sales are booming, but it also shows new home sales are booming. It shows building permits are way up. So what kind of companies would you want to be looking at that point? You'd want to be looking at builders, anybody involved with real estate, whether it's a Home Depot or B&Q out of London, whether there's anything tied to the housing market and existing or new home sales. We're not talking big real estate companies, but we're talking about when home sales are up, furniture sales, retail sales go up, furniture manufacturers, people are moving new homes, that means they're buying new furniture. Okay, people are buying new homes in the U.S. means there are more appliances being sold. Okay, there's more decorative items. Paint companies are doing better because when you get a good report, a good economic report on home sales, so you have to understand all of this data, where it's coming from. And the economic reports don't necessarily tie to earnings statements because earnings statements come out at specific times for each quarter. But all these stocks can be adjusted and react to fundamental analysis through market events, news, and headline. What do you think is happening in the U.S. today with Mr. Trump and all of his new tariffs that he's putting out and starting this trade war? It's going to affect certain values of certain stocks. Now, he's warning he won't ever do it. But he's now warning to stop all importing of European cars into the U.S., especially German cars. Well, what do you think this effect's going to have on Volkswagen, BMW, and Mercedes-Benz stock in the U.S.? What do you think is going to happen into BMW, the stocks trading on the DAX? Okay, now it's going to be a short-term thing, but fundamental analysis includes news and headlines, press releases, and other market events. Now, for the national economy, fundamental analysis might focus on economic data to assess the present and future growth of the economy. Fundamentalists do not heed the advice of random walkers and believe that markets are weak form efficient. But by believing that prices do not accurately reflect all available information, fundamental analysts look to capitalize on perceived price discrepancies. So they look to forecast the weather conditions of the market. Now, successful traders need to be aware of market conditions and plan accordingly. Fundamental traders prefer to trade based on news and other fundamental and political data. Technical traders prefer technical analysis tools such as Fibonacci retracements and other indicators to forecast market movement. Most traders use a combination of both, and this is my recommendation. Because fundamental analysis can help you determine an asset you would want to buy or sell, but it can't really help you determine what point you want to actually enter the market. It can't help you to where to put your stop loss, and it really can't help you with an exit point. You get this from your technical analysis. But if you become a technician and just start trading by technicals, a wacky piece of information, a bad piece of news, or a bad economic report, or a comment from a central banker can mess up all of your technical information in a second. So no matter what your style, it's important you use the tools at your disposal to find potential trading opportunities in moving markets. So the key concept in fundamental analysis for Forex traders, analyzing the market fundamentals, whether the underlying asset is a stock, bond, commodity, or Forex, currency pair remains a cornerstone of how trading decisions are made for many professional and retail operators. So in other words, we have good economic results. It should push the currency higher for that country, and bad economic results should push the currency lower. But it's not purely technical, as I was saying. For those who are not purely technical, performing sound fundamental analysis before initiating a trade can make significant differences in the overall success of a trading position. And this is especially true for longer-term position traders. For example, knowing how a currency pair may react to a major central bank decision before it's released and what the market is expecting to happen by going through a basic Forex fundamental analysis process can be very helpful to a currency trader when establishing or liquidating a position. Now, like tomorrow, which happens the first Friday of each month, just about always, except on holiday weeks, is the U.S. non-farm payroll report. Now, understanding what's leading into it, how it's going to affect the dollar and the price of gold, what the market expectations are, will help you establish a position or liquidate a position. Now, you could be a short-term trader looking to take advantage of market volatility at the moment, or you could be a longer-term trader that's looking to see, was it good enough to eventually push the US dollar up against the euro, or will it push gold down, or how will it affect the central bank's decision to increase rates, and therefore what effect will it have on the currencies, the stock market, and metals. Now, fundamental analysis is one of two main methodologies for evaluating and forecasting movements in currency exchange rates. The other primary use is known as technical analysis, which we've already mentioned, which focuses on markets observables like exchange rates and price of an asset, the volume traded and open interest. The basic skill involved in fundamental analysis in Forex trading requires an analyst to determine how a currency will react to macroeconomic events, central bank monetary policy shifts, and political and social news from the currency's nation of origin when compared with other currencies in a currency pair. In the case of a common regional currency such as the euro, the analysis of each member state in addition to the entire regional economy as a whole is required to make accurate fundamental evaluation of the currency. What happened to the euro earlier this week? The euro took a beating against all of its cross pairs because of the Italian political mess and the election situation. Basically, currency pairs tend to react sharply to the release of economic data and current geopolitical and local news events, especially when the results differ significantly from what was originally expected by consensus of market participants. This makes performing fundamental analysis of economic releases and events and their effect on currency value when determining the direction of the market and the level of future exchange rates. Fundamental analysis has traditionally been better suited for traders who operate on a longer-term time frame. But most of us today are CFD traders who are trading in very short time frames. The method involves analyzing a nation's overall economic strength, its interest rates, its central bank monetary policy, its money supply, its trade and current account balances, as well as the country's overall political stability. So, nevertheless, some fundamental traders use short-term news trading strategies that generally operate right after the release of major economic numbers, central bank rate decisions, or news of major geopolitical events such as war or natural disaster. Now, regardless of which type of methodology best fits a trader's trading plan, research remains a key element in successful fundamental or technical trading. And most traders find a working knowledge of both analytical methods beneficial. The most useful tool for fundamental analysis consists of the economics calendar, the financial news media, and historic fundamental data. The economic calendar informs traders on the scheduled time and date of the releases of major and minor economic data that can have an effect on the nation's currency. Like I was just mentioning, housing reports or tomorrow's non-farms payroll report. And we get these from an economics calendar. Now, we came tonight through investing.com, and if you just go to investing.com and look under the heading economics calendar, click on it, you'll see all the ways to set it up, and you'll see all the major events for around the globe, what they're forecast at, what they're predicted to be, and you can see them exactly when they're released, exactly what the results are. Now, trading news broadcasts from the financial news media keeps the market informed of any major economic and geopolitical developments that could directly or indirectly affect that market. But news trading, headline news trading, is very, very difficult. Because today, with all this online news and all this fake news and all these news sources online that are reprinting of somebody else's data, today we don't really, in most cases, have in-depth reporting. What you have is a guy writing for a big financial blog that's never left his office. And what he does, he reads something on CNN and reads something later on Bloomberg, and then he takes that data together, puts it together in an article and publishes his article with his headline. But he hasn't done any actual research. And what happens is you get this new headline splashing up across your screen, but it's on something that happened 2 hours ago that's now fully reversed itself. And so news trading is very difficult unless you isolate specific news suppliers and know how fast you're getting that news. Because the big traders, the hedge funds, the financial traders, the ones that are affecting the market, get that news from the source instantaneously. You getting a headline on Bloomberg an hour after the happening has happened or that Trump did something doesn't help you that much because the markets have already reacted. Now, another tool under fundamental analysis is historical data. Historical fundamental data can be useful to determine trends in fundamental indicators as well as to analyze how a currency might react to a specific economic release after examining its behavior in the wake of previous releases or central bank rate decision. So we can go back and see how the markets reacted when the Federal Reserve raised interest rates 1/4 of a point. Is this the third raise this year? And they were predicting only 3. Okay. What happened when the housing report came out last month or 2 months ago? Or what happened when the housing report was released exactly a year ago? Okay. We also can look at things like weather reports. Natural gas is very cyclical, but if the temperature get too hot early in the US, natural gas prices go up because there's a demand for air conditioning. Okay. If the winter comes very, very late and it's not a harsh winter, the demand for heating oil and natural gas has dropped. So we can see how these prices were affected the previous year, how the weather pattern was. Is the weather pattern duplicating what it was 2 years ago or 4 years ago? And how did natural gas prices react to a late spring or early fall? So some of the major fundamental analysis indicators used by currency traders to determine the overall strength of a country's economy and potential exchange rate forecasts include GDP, gross domestic product. You'll hear about it quite often. Okay, employment data, and like I mentioned, tomorrow is the U.S. non-farms payroll report. Trade balance, especially the trade balance out of China. Retail sales in the U.S., but retail sales from each of your countries. If you're looking at the Aussie dollar, you need to be looking at the retail sales for Australia. If you're looking at how the U.S. dollar is going to cross, or if the U.S. dollars can go up, okay, we want to see U.S. retail sales. Inflation is very, very important. You hear central banks talking about it. You get the inflation reports from the Bank of England. You get CPI, which is Consumer Price Index, and all of this has a direct effect on the economy, but also a direct effect on the central bank's action and reaction. Why is Mario Draghi taking his time getting out of the QA? Because inflation is relatively low in the Eurozone. Inflation jumps up, he's going to have to start raising interest rates, so he needs to get out of his QE situation and get to the point where they can start raising rates. So these are reasons that these reports have short-term effects and longer-term effects. So some of them may also give traders an idea of what a future release could look like, such as a preliminary GDP or survey of numbers. Now, in order to use these all correctly, you have to understand them. Like again, in the US, housing is in a cycle. Because in the US, even though you buy a new construction home, it's not counted as a housing sale until the house is built, you've paid for it, you've closed on it. So how do we tell if the housing market's doing good in new home sales? Because that's when you've taken possession. But it takes a long cycle. So we start out in the US by looking at building permits. Okay, building permits are being pulled when the builder is ready to start construction. Okay, so that means he's got a house that's been purchased because he's ready to start construction. So he's pulling a building permit. Okay, and there's this whole cycle of being able to predict how the overall housing economy is doing, which helps understanding how the whole economy is doing. Or, like I said, tomorrow is the U.S. non-farms payroll report. Now, we can see over the month several other reports that will have an effect on the non-farms payroll report. Like when we see manufacturing data. If manufacturing is doing good, that means they're hiring. Then we see the weekly, every Thursday, the unemployment data. How many people are filing unemployment claims? If we see that number falling or staying steady, we know there's just jobs out there, people aren't being laid off and fired. Okay. Then we have on the Wednesday before, we have the ADP payroll report, which is a precursor for the Friday's non-farms payroll report. So we have to understand how all of these link together to give us a future look of what the next report should be and how they all link back to the economy. So furthermore, some economic indicators often lead other indicators in signaling when an economy is turning up or down. The leading fundamental economic indicators include PMI, Purchasing Managers Survey or Purchasing Managers Index, Producers Price Index or PPI data, and durable goods orders. Now, durable goods orders is a major number predominantly for the US. Durable goods are all of those goods that are produced that I believe, I can't remember, but I think it's cost more than $100. Because durable goods fall under, a refrigerator is a durable good. Okay, a washing machine, things that have a longer lifespan and have not an exceptionally high price point, but are not things you're just buying to use and throw away. Okay, and so durable goods numbers are very important. We also have durable goods minus airlines, airplanes. We have durable goods less transportation. Okay, we have durable goods because sometimes we want to take cars out of that sale, or sometimes a sale of 10 Boeing jets can have, because these are all factory orders and factory goods, can throw that number. So we want to see durable goods minus transportation or minus airlines. Okay, and we need to know how to look at these numbers to derive values from them. So let's take a look at some of the key fundamental economic indicators used by Forex traders. So again, I've mentioned over and over, is the jobs report. And every country releases their jobs data. In the UK, it's called the claimant count. In Australia, it's called the jobs report. In the US, it's called the NFP report, non-farms payroll report. But these have a good view of how the economy is doing. If people are secure in their jobs, they're spending money. If people are spending money, retail sales are going up. Retail sales are going up. Manufacturing is going up, and imported goods are going up. Okay, so all of it, if people are secure in their jobs, they're buying new cars. They're buying new houses. Okay, so jobs, employment data is very, very important to not just the stock market, but to the Forex or the value of the currency. Okay, trade balance. This is the difference between a country's import and export, which has a direct effect on the demand for the nation's currency. A deficit would mean the country is importing more than it's exporting, while a surplus would indicate more exports than imports. Like China for a long time was a major exporter, but didn't import many goods. Now they're starting to become a consumer economy, and they're starting to import. Their exports still exceed their imports. And remember, for all the things they're exporting, a lot of times they have to import the goods to manufacture to export. So we want to look at this very closely. current account balance is one of the two components of the nature's balance of payments. It's the cash money flowing in and out of the country. How many bills are having to be paid out, how much money is coming in, including foreign investment. At GDP, gross domestic product. Gross domestic product have a notable effects on a country's currency. A sharp increase in GDP indicates strength in the economy that could stimulate appreciation in its currency, but it could also make the central bank ready to increase rates. And then CPI, or inflation, shows the level of prices and products on the consumer level and is a key inflation indicator. Controlling inflation is one of the first mandates of most central banks. So CPI changes can directly influence monetary policy. All of this flows directly back to the value of the currency and where currency is moving. If the US economy is doing good, foreign investors will tend to buy US dollars. Or it's also considered a safe haven. When there's other panic in the world, people will buy up dollars. But would you buy the Turkish lira right now? No. So money is flowing out of Turkey and flowing out of its currency and into other currencies. Okay. Now, there's certain other index like PPI index, the producer's price index. It's a gauge what manufacturers are paying for their material before making a finished product. This number affects the nation's currency because a higher PPI suggests higher consumer prices and increases consumer inflation. And then the underlying supporting of most is PMI, Purchasing Managers Index. Okay. Now these surveys are released. There's tons of PMI surveys are released by almost every country. And in the UK, we have construction PMI, we have services PMI, we have financial PMI, we have manufacturing PMI, and all of these are considered leading economic indicators. Purchasing managers generally are first to know of increases and decreases in future production and can indicate the strength and weakness in not just the manufacturing. We have, like I said, in the UK, we have construction, we have services, we have non-services, we have financial, we have manufacturing. Because the purchasing manager has to be buying the raw materials. So if it's in construction, he's not buying the raw materials today for what he needs today. He's buying raw materials or putting orders in for lumber that he needs 6 months from now, or steel he needs in 8 months from now. So they can also see the demand or how much they're buying up, and also how the price is affecting this. And also the price of commodities can have a significant effect on the currency of both producing and consumer nations. Why are we always looking at not just crude oil prices, but we're looking at crude oil imports and exports? We're not concerned as much as how it affects the pump. But when price goes up of crude oil, it means that manufacturing costs are going up. Manufacturing costs are going up, it rolls out everywhere. So it not only affects you at the pump and gasoline prices, because not every country has got a big transportation like the US does. Okay. But these numbers are all important. And then we have national credit quality. Other reasons for reevaluating a nation's currency would be if the nation's credit quality improved or deteriorated. What did we hear during the financial crisis when we had Greece in a mess, Portugal in a mess, Italy? What happened was their credit ratings were going down, their bond costs were going up, and it unfortunately was all the euro, and the euro was getting killed. And then last but not least, we have central bank monetary policy. Each major economy has a central bank that typically manages its currency benchmark interest rates and money supply. Central bank activity and speeches by central bank officials are closely watched by fundamental traders for clues about future monetary policy shifts. Because they control interest rate decisions. The amount of interest charged by a central bank is extremely important to the valuation of a nation's currency. If a country's central bank sets a high interest rate, barring other factors such as political instability, for example, the nation's currency tends to attract foreign assets from countries with lower interest rates. Look, Turkey raised their interest rate the other day to 16.5%. Well, most of us would love to put our money in a bank that's paying 16.5% interest. But because of political instability, not being able to get your money back out, would you be buying up Turkish lira? No. But when the U.S. raises its rates, it has a direct effect on foreign money because you're sitting with a couple $1 million, a corporation, you're sitting in the bank in a Bank of England making no money, and the interest rates in the U.S. are getting higher. You're going to buy up dollars or move your money into the U.S. So it attracts foreign assets, but U.S. corporations get killed because their debt and their payments go up, and consumers get killed because their credit card interest rates go up, mortgages get higher. So we have to be able to balance it out, understand what is happening. Because central bank monetary policy and their statements have a big effect. Most central banks issue a statement after their rate release describing their monetary policy committee's voting and the reason the rate was changed or left unchanged. The statement could affect the market if the policymakers' voting was unexpected or if the central bank becomes more hawkish or dovish. So, of course, we learned up until a few years ago, well, actually, it was Ben Bernanke who actually coined the phrase quantitative easing. But asset purchases and quantitative easing weren't even something that was thought of. But today, a central bank buying up, or adding to its asset purchases quantitative easing has an effect on the money supply and the value of the country. Because basically, it means the central bank is mass producing money. So when the ECB is buying up tons of stuff and dumping money into the economy through quantitative easing, or QA, it means the value of the currency is going down because they're overproducing. It's no different than a manufacturer who's producing more widgets than the market demand for widgets is. Well, if he's trying to lower the price or put extra widgets in the market, that's fine, but the price will fall. And then, of course, we have geopolitical events, and these can affect the market in every which way possible. We have wars, we have breakout of escalations, we have threats, we have elections. Elections, the U.S. election doesn't really have much of an effect on the value. It can affect the stock market, doesn't have a value change of the currency. Like when Trump was elected, the market soared because of his business outlook, and his promises, lower taxation, less restraints on corporations, less laws. Okay. And so depending on who's taking office, but because in a lot of countries, these elections can change or throw a whole party out and put a whole new party in that becomes Euro skeptics, or they support the Euro, or they want to leave the Eurozone. All of this can have very big effects on the currency. And then, of course, power changes, overthrows. If you were trading, we saw the Arab Spring. We don't have this much. And, if you're trading exotics, maybe. But on the whole, we don't have this major problem. And then natural disasters. Natural disasters can have a big effect on currency values as well as the market and commodities. Okay, the perfect example is, why do we really care, outside of a human nature, why do we really care about how much damage is done by a hurricane hitting, the southwest of the U.S. or southeast of the U.S. when you live in London? Well, it has an effect. It has an effect on the dollar value. It has an effect on the overall economy. It has an effect on commodities being produced. Or 2 years ago when we had the major wildfires in Canada. Well, yes, it's a Canadian problem. The Canadian dollar got killed, but Canada is also one of the major exporters of crude oil. But that one little, and that there's affected all the crude oil fields, so everything was being locked down. That one little shift in the production of crude oil sent the price of oil much, much higher all over the whole world. And then, of course, we have market sentiment. Market sentiment affects everything from commodities to currencies to stocks. So it's how much risk or risk appetite or risk aversion the overall market has. How do people feel? Do they feel optimistic? Are they worried? Are they willing to make more risky investments? So formerly called flight to quality, until quality became something of a misnomer, risk appetite and aversion are the latest market terms used to refer to investor preference for higher yielding and higher risk currencies. Now, whenever there's a panic in the market around the world, okay, for any which reason, the Japanese yen is considered a safe haven currency. So is the US dollar. It used to be gold. Okay. So for example, in a risk-adverse market environment, economic and political stability is favored. So the Japanese yen, US dollar generally appreciate over European majors and commodity currencies like the Australian, New Zealand, and Canadian dollars. If risk appetite is high, though, that means people are willing to take on high risk because they want to make higher profits. And that's also seasonal. Then the higher yielding commodity currencies and other risky minor currencies typically rally. So in addition to risk, we also have financial surveys, okay? And every major economy releases market sentiment indicators in the form of surveys and indexes, generally on a monthly basis. Consumer confidence is very important. PMI we talked about earlier, but consumer confidence is one of those reports we look at around the globe. When consumer confidence is high, it means the wheels of the economic cycle are turning. When consumer confidence is falling, those wheels start to fall. Now, some fundamental traders use economic news and data releases to initiate and liquidate short-term trades based on the results of the release. While it may sound simple to trade fundamental news, often the markets will not react as expected, and in most cases, it will move in a completely opposite direction to what traders would intuitively expect. Furthermore, volatility surges involve the purchase and sale of options can be useful for opening a market neutral position that will appreciate with a significant move in either direction. Another way to take advantage of extreme news related volatility when trading with fundamental is to establish both long and short-term positions in current currency pairs and then trade out of each position as the market bounces up or down. But you have to understand these because sometimes the market's already taken into account a central bank action. And so before that action already happens, the markets have already pushed the asset up or down. Okay. Most professionals try to avoid having large positions immediately prior to significant economic news, simply because the volatility immediately after a major release could trigger stop positions in either side of the market. Despite the volatility, having a position coming into a number can allow a trader to take advantage of the volatility. The trader can unload their position at a profit and possibly reverse the position to take advantage of the rubber band effect that generally occurs. But you must be able to cover the stop loss. You must be able to allow for that volatility and be able to afford to trade that volatility. Now, trading fundamental analysis gives Forex traders a deeper understanding of how the market reacts to a variety of events. Nevertheless, having knowledge of technical analysis along with fundamental can give the trader a significant edge over a trader that only uses one methodology. So fundamental trading involves taking shorter-term Forex positions can also make sense with a trading plan that allows for wider springs in the market. Some traders might buy option combinations like straddles or strangles with both calls and puts to capitalize on the brief volatility often seen immediately after the release of a number. Long-term Forex position traders evaluate a country's economic releases over a more extended period. This helps give a Forex trader a more accurate evaluation of a nation's economic, socio-political environment, and monetary policy to establish long-term positions in the market. So regardless of whether you are a short-term or long-term trader, applying sound fundamental analysis can help guide you in your overall trade decision. And on that note, we're going to say goodnight. Thank you very much for joining us, and come to our webinars on Trading the Economics calendar, and we'll teach you how to evaluate each event and how to build market neutral, market positive and market negative results, and how to pick positions and take positions on these trades. So make sure you come to one of our webinars on that, or use the videos that are available on CMS Trader to understand how to trade from the economics calendar. Good night now.